Hey guys, what's happening? Nothing much in the markets lately, huh? Pretty boring activity. It's just pretty steady Eddie. Of course, we all know that's not right. So there's been a lot of activity in the market. So I want to talk about that today. I'm going to be pretty open about the my portfolio value, where it's at compared to the market, and so we're going to look at some of that. We will look at just some things that I think we should keep in mind as investors for turbulent times like this. I think it's important that for when we have market uncertainty, that there are certain tips, there are certain things that we need to just keep forefront of mind during all this market uncertainty, and I think it will pay off for us in the long run. So I don't think you're going to want to miss any of these, and I'm excited about going through them with you, actually. So glad you guys are here, and I know there's a little bit of competition tonight with some kind of I don't know. There's a little basketball game or something. So we'll see how it goes. But you know what? Unless you got a lot of money bet on the game, I think we're going to make more money here than we will with the basketball game. And I promise I won't keep you too long. So with that, let's see who all's on here. If you're watching, give me a little shout here so I know you're here. We've got Michael Swami. Giddy to see some buying opportunities. Absolutely, man. This getting close, man. I want to talk a little bit about that as we move forward. And beekeeper, man, guess what? We're going to have, it's a little cold to get in the beehives right now. I was hoping to get in there today, but it's just too cold. I don't want to chill them. And, but anyway, we're going to have people coming to pick up bees here at my property. The bees will be here Wednesday, probably, late in the evening on Wednesday. People are coming to pick them up on Thursday. And let me tell you, there's going to be about 800,000 bees on this property. Fortunately, most of them will be in cages, and we want to keep it that way because that's a lot of bees, man. So yeah, it's getting exciting, man. Hopefully this freeze that's coming through isn't really a bad freeze and it doesn't freeze the flowers, because if it does, then our honey crop could be in jeopardy. So we'll see. Michael Swami, go Cougs, yes sir. So I'm in a what is that called? The thing where you pick who's going to win March Madness. Here, I'll look it up real quick. The bracket. It's a bracket. So why couldn't I remember bracket? But anyway, I'm in a bracket for the for this thing, and my team, which was Duke. I don't know. I say it was my team. It's the team that I picked. Not that I've been to Duke or that I'm necessarily a Duke fan, but that's who I had picked in the bracket. And they lost Saturday in underwhelming fashion. So, but anyway, I am in first place currently in the bracket. I don't even have a team playing. Actually, I had picked Florida to go to the championship, but I picked Duke to win it all. So the second place person has Florida winning it all. So if Florida wins, then I come in second. If Florida loses, then I come in first. So, even without having a team, I can still win. So that's pretty cool. Anyway, but yeah, go Cougs. I'm pulling for the Cougs as well. Not that I picked them, but because I need them to beat Florida. So there you go. Mr. Pat, what a wild couple of weeks. Dividends are holding strong, at least for now. Yeah, that's right. So, we'll just have to see where that goes. But I don't think there's anything fundamentally different today than there was last week. I think there's a lot of fear, and now, granted, if it keeps up for longer term, then we could see stuff. But I just don't know. I don't know yet. Jury's still out for me, Pat. And you are right. We don't make a dime or lose a dime until we hit that sell button, and we're investors. We're not traders. So, if the market goes down, it goes down. we're in it for the long term. I've got a chart I'm going to show you here in a little bit that helps with where my perspective is on that. Rust is here. Nathan, good to see you, my friend. Yeah, unless you have dividend stocks, you get paid dimes for not selling. That is right, man. They will pay you out of the company coffers for doing absolutely nothing. So that's a fantastic reason to have dividend stocks in your portfolio. So let's see. Yeah, Pat, this is a good point. I have friends freaked out, but my dividends just keep coming. I will only sell if a company cuts its dividend. I'm an old guy, so I don't worry as much about growth. I hear you, man. I hear you about the old side, brother. But yeah, that's right. Unless the company cuts its dividend, we're in good shape. We're in it for the long term. Hey, Mr. Brad Durfee's in the house. Good to see you, Brad. Shannon is here all the way from Atlanta. And let's see who else. Steve C's. Good to see you, man. He bought some EBF today. Does that have an SSD score? I'm not really sure. We'll look it up. I'll write it on the back of an envelope. It's my scratch paper. EBF. I'll take a look here in a little bit. Oh, never mind. Pat's already done it. It's got a 61 safe score. So there you go. So now I can scratch that off my to-do list. Let's see here. Thanks, Pat. Greetings. Sorry. El Dynamico, all the way from California. Greetings and a cup of Joe to everybody. Good deal. I've got a glass of tea, and this is unsweetened tea, by the way. Normally, I get half and half if I go to a restaurant. I do like a little bit of sweetness. I got a bit of a sweet tooth, but man, the tea here in Alabama is really sweet. So I usually get them to do half and half sweet, half unsweet, and it's just about right for me. Free the bees. Yeah, that is the idea. I mean, people will come and get them. They have their hives set up and ready to go. They're going to take these packages to their home and free those bees out of those cages and let them begin building their new home in these new hives. So that's what the plan is, Steve. So we'll see how well it goes. But that's a lot of bees for this area, isn't it? Yeah. Oh well. But I tell you what, not that you asked, but there is it's a mite. It's a parasite that's called the varroa mite, and it is pretty destructive. I saw a study about a month ago that says that about half of the hives in the U.S. or at least over the past year, was lost, and the biggest culprit is that mite. So we got to keep these bee populations populating because we definitely don't want to lose them. So if anybody wants to get into bees, let me know. I can hook you up. So El Dynamico wants the prices to stay down come payday. I don't blame you, man. I mean, this has got to be a dream for younger people who are DCAing into the market. And, this is a great time. I had a couple of these during my younger years. And it, I was able to buy stocks at cheap prices. So there we go. Oh, my buddy Russ. Russ is in the house. He started buying Starbucks again. Wow. Okay. Long run, they'll be fine. Okay. So that's good. I haven't looked at Starbucks in a while. Maybe I will pick them up on just for my own benefit because I haven't looked at them in a long time. So let's take a look at them here in a little bit. Do you think the tariffs will last? I think Congress steps in because they have constitutional authority to regulate trade, in my opinion. Yeah, I don't know. I think it right now anyway. I think Congress is wanting to carry out President Trump's agenda, and so with that, I think at least for the next for 2 years, I think it will go that way if things don't kind of settle down before election time. think we could probably see a different letter on those Congress positions. So we'll just have to see. I don't know. I'm not a politician. I don't really like politics that much. I do like to think about policy, but man, I could not stand to think about running for office. That would be the most miserable existence I can think of. I mean, everybody's trying to discredit you, and you know, everybody's wanting you to go down. So now I don't like that. So, but anyway, yeah, that's my thought, Russ. I think for the next, year and a half, it's probably gonna be whatever Trump wants, and then after that, we'll just have to see. I don't know. Michael, Southern sweet tea is made by people who like a little tea in their sugar. That's right. It's just brown sugar, basically. That's all it is. Fast Eddie's in the house. Good to see you, my friend. Yeah, I think the curves are just to get other countries to the bargaining table. Yeah, I think that's it too. And I will tell you that based on what I saw today, there was some fake news about I forget exactly what it was. Oh, that the Trump was going to push the tariffs out 90 days. This was obviously not true, and so the market swung like 7% even on fake news. So I think if anything positive happens, I think people are going to be jumping back into the market. So I think we have to be ready to pull the trigger, although I'm not ready yet. I think this knife is still going to be falling for a little while. So I would keep some dry powder. So that's what we'll talk about tonight. No, your opinion is not useless, my friend. None of our opinions are useless. They are what they are. They are our opinions. So, all right. Well, that sounds good. We got a few of us here. And I think what I'm going to do now is get into what I wanted to talk about, which is obviously, when you look at the screen, nothing, because I haven't shared anything yet. So let's take a look. Let's share that. Oh, yeah, there we go. That's a good looking hat, huh? So market uncertainty, my approach to handling the current market uncertainty. As you can tell, I'm not concerned about the market. I am I started to say older, but I don't know if I wanted to say that or not. But anyway, as you'll see here in a minute, this was pretty painful, right? But I don't trust in my portfolio. I try to manage my portfolio. I do the best I can do with it. But the market is the market and life is life. So I try to keep those separate. And I don't lose any sleep over this stuff. If I have, 7 figures or 6 figures or 8 figures at the end of the day, it doesn't really matter to me. So as long as I have some figures, I'm good. All right. So let's see here. Let's hit. There we go. All right. So let's start off this with me sharing with you, and I shared this with you last week. I'm just doing this for a comparison. So year to date, as of March 31st, the portfolio was down 0.47%. You can see the other indices with that. So I've updated that for April the 4th, which was basically 4 days later. I didn't update it for today's activity, but today's activity, even though there were wild fluctuations, at the end of the day, it was minor. So I'm just going to show you the 4/4 numbers. So here we are. Now, instead of being down 0.47%, now the portfolio is down 8.32%. That's pretty significant swing, but you can see that the S&P, NASDAQ, Dow Jones, Russell 2000, all of them are performing much worse than the portfolio. And that's by design. It's my portfolio is designed to have less volatility than the market. And, so when the market goes down, it doesn't go down as much. When the market goes up, it doesn't go up as much. So my band is tighter. And so, yeah, there's that. So here's some things that, if I weren't properly grounded would kind of make me worry, but I just thought I'd share this with you to let you know that I've got some skin in the game here, right? So year to date return, you see is minus 8.3%. Look at the week. The week I lost 7.4% in 1 week in the market. And that equates to $113,340. So that's a pretty big chunk of change. I mean, what could you buy for that? You can almost buy a house for that in some places, not California, but you could buy a double wide for that, I'm sure. But that's a chunk of change, right? And so we're down 8.3% or 113 grand for the year. So I just wanted to share with you some things that kind of help put this in perspective. So first of all, I'm going to share some Morgan Housel observations. Secondly, I'm going to share some margin of safety, risk management stuff, and then I'm going to kind of wrap it up with some tips that we can use. So you're going to have to suffer through the education to get the tips. Here we go. So Morgan Housel wrote The Psychology of Money. Here's just some points that he made I thought were very poignant for this. Successful investing is not about how smart we are, but about how we behave. So it's about our behavior, not about our learning. There are at least two sides to money and investing. One side is the mathematical side, and it's got the rules and the laws. So 2 + 2 = 4, right? And so, that's where we find all the numbers associated with investing. But we are not taught enough about the psychology side, which has to do with emotions and nuance, because, that's really where the rubber meets the road. And I think that's what we're seeing in the market today. Yeah, you're right, Russ. I should have looked that up. I don't know why I call him Morgan Housel, but it is Morgan Housel. So that's why I need you here, man. That's why I need you on the program, is to keep me straight so that, but anyway, it's not Housley, it's Housel. So let me just change that real quick. Then I was never wrong, right? So Morgan Housel's observations. How does that sound? Is that much better? There we go. So anyway, now I got to correct the next screen as well. So bear with me as I do that. There we go. Now we're good. Here's a few other things. Luck and risk are powerful reasons our investing performance does not depend on our smarts. First of all, Benjamin Graham, the Benjamin Graham who wrote the book that Warren Buffett, and I'm losing the title of it off the top of my head, but he wrote the book that Warren Buffett read, and it got him into investing. He disobeyed his own diversification rules, buying Geico, which launched his success in investing. That was one of his best investments, and that's what made him kind of a wealthy man. Risk is the intelligent investor. Thanks, Michael. Risk is ever present and needs to be managed. So risk is always at work in our portfolio and needs to be managed. We're going to talk about what those risks are and how to address those risks. The biggest risks are structural and may not have happened yet. So examples are the Great Depression. In 1928, there had never been a Great Depression. 1929, boom, there it is. 9/11 in 2000, there had never been a 9/11. 2001, there it is. The pandemic in 2019, well, I guess there had been a pandemic, but it had been 100 years prior, and so none of us remembered the pandemic, and we all thought that we would never have to deal with something like that in our scientific environment. The great financial crisis, in 2007, we never saw that coming. So what's the next big thing? And guess what? It is tariffs. We never saw that coming, and then boom, here it is. So what we're dealing with today are structural things. They are things that we never would have thought would happen. And All of a sudden, they're here. All right, business. Here's the sources of risk. There's business risk, so let me just read them: business risk, financial risk, valuation risk, liquidity risk, and market risk. When we talk about managing risk, these are the risks that we're talking about. I will tell you, I'll give away some things here. You can diversify and you can do some risk management techniques around the first four, but market risk is, as long as you are in the market, market risk is very difficult to get rid of because it will cost you more to hedge all of that market risk than you will get from the returns after your hedge expense. So market risk is difficult to get rid of. Let me just put it that way. There's some emotional biases, and I think what we're seeing today is fear. There's a lot of fear. There's panic selling. I heard a guy today who I respect a lot. I forget his name. I've listened to him several times, but he believes that there's a lot of leverage in the market, and that leverage is being backed out because as the market drops, then these people have to find cash somewhere to get these debt calls and things like that. So he thinks that it's pushing a lot of leverage out of the market, which might actually be a good thing. He also believes that we are probably about fair value in the market today. We were way overvalued. Now we are about fair value, and he believes there's room to move because he doesn't think it's going to turn around until the market gets kind of cheap, right? Sources of market inefficiency. So how can we as investors make money in the market? And that is when the market is inefficient. The market doesn't know everything, and investors are emotional at times. They have a short-term focus at times and have a herd mentality at times. It's our job as investors to identify these times and go and do what we need to do as investors to take advantage of these particular inefficiencies. And guess what? I see all of them at play right now. I see them all. So I think it's time. So here's some risk management techniques, right? One is margin of safety. And basically what that means is if you're going to buy a stock today, make sure that you're getting enough value, that the price is low enough that you get some margin to actually cover anything that could go wrong. So if you believe a stock's worth $100 and it's trading for 80, that's a 20% margin of safety. Maybe that's enough. Maybe it's not. Maybe you want 30%. Maybe you want 40%. But make sure that you're getting enough margin of safety. Diversification is another risk management technique. So risk management is margin of safety, right? You're paying less for a stock than you believe it's worth. So that gives you some margin to cover any risks that you don't know about, right? Diversification is another risk management tool. Basically what you're doing there is you're spreading out the risk over, sectors, even individual stocks. It's almost impossible though through diversification to diversify out market risk. That's why I mentioned that earlier. So diversification works great, but it does not get rid of market risk. Focus on quality is another risk management technique. So if you've got companies who are doing well and their management team is solid, they've got a strong balance sheet, they're just a quality company, that's going to help you with any risks in the market, right? The market risk can somewhat be muted by that. Also, active portfolio management. I will tell you this, I was talking to somebody the other day, and there's a thought out there that how does it go? Some of the best performing portfolios are from dead people. And the theory there is that it's because they never touch them. And I think that's probably true. I think the more we touch our portfolios, sometimes the worse it gets. There's a anecdote out there that says it's like a bar of soap. The more you handle it, the smaller it gets. So, I think we should be careful about having a lot of transactions in our portfolio. But I also think it's important to stay on top of our portfolios as things change, as we, as a management team, makes bad decisions, um, as we identify a particular company that's going to be hurt really bad with tariffs. I think it's we got to make decisions around those types of things. And then hedging, I don't hedge a lot. Hedging is expensive, and I just basically accept that market risk. I'm in the market, right? So I accept that market risk. You could buy or sell puts and calls on, let's say, the S&P 500 to kind of hedge out the market risk, but it's expensive to do that, and I don't do it, and I don't recommend that we all do it. So here's some tips. You ready for some tips? Tips for weathering market uncertainty. We can identify emotions like fear in the market, but don't make decisions based on them. So I see a lot of fear. As a matter of fact, if I were to pull up that CNN fear index, or fear and greed index, I think they call it, you would see that it is well into that fear range. And so there's a lot of fear out there. And I get that, right? So if you're an investor and you're feeling that fear, I would say, stop being fearful. And I'll show you why here in a minute. But and it's okay to have those emotions, but identify them and don't make decisions based on them. Make decisions based on good, solid risk management and investing principles, and you should be fine, right? All right. Here's tip number 2, protect your portfolio using solid risk management techniques. Due diligence. Make sure that you understand the company's balance sheet. Make sure you understand what they do, how they make money. Make sure that you understand their capital allocation process. So just do your due diligence on every stock that you buy. The second one is margin of safety. You want to buy it. You want to buy quality companies at what you believe is below their intrinsic value. And if that's the case, you got some safety margin there in case there's things that you just didn't foresee. Diversification is a great risk management tool to manage risks of a portfolio. And then ultimately focus on investment quality. So in times like this, we want to buy the quality companies. They're on sale. Why not buy quality when you can? And now is a time you can buy quality. And this plays not just in the stock market, but like, for instance, here on the farm, I don't buy the cheapest equipment. So I have a John Deere 5103 tractor. And I mean, it's a big tractor, right? But it's a solid piece of machinery. It's not a tractor that's going to tear up in 5 years. As a matter of fact, it should last me 50 years, right? So so even on the farm, I look for quality when I can get it. And, I don't want to pay too much for it. I want it to be, win-win. But it's the same in the stock market. We're looking for quality assets to put in our portfolio, and if we can get them at prices that are at fair value or below, why aren't we buying quality? Why are we chasing after things that aren't quality? So I'll throw that out to you. The other tip here is focus on the long term. I put this, see if I can make this a little bit bigger for you. Hopefully you can see that. There, that's about as big as I can get it. The S&P 500 has returned 10% per year on average since 1950. So take a look at all of the events that have occurred. There was a Korean War, a Cuban Missile Crisis, John F. Kennedy was killed, the Vietnam War, stagflation, 18% mortgage rates, Black Monday, the Gulf War, the Soviet Union collapses, dot-com bubble, September 11th, Y2K, the Iraq War, etc., etc., etc. And now we're in the tariff time. And so what we're going to see on this chart is that it's going to go down. But over the long term, the market has proven to us that it will grow at a reasonable pace over time, over the long term. So I'm not concerned that I'm going to lose my investments here. I think what we're going through is a reset. I think in the long run, it's going to continue on its upward trend. It just might take it a little while to get there. So anyway, focus on the long term. And then lastly, take advantage of market pullbacks. So if you're looking at some really high quality stocks and they are cheap, they're under what you believe their intrinsic value is, might not be a bad time to take advantage of some of those market pullbacks. So that's kind of the way I look at it, guys. I'm not concerned about this tariff thing. I'll let the politicians figure all of that out. Whether it's the right thing to do or not, I believe that the economy in the U.S. is resilient and it's strong and it's going to weather this storm just like all the other things that we've gone through as a country. So there we go. We got that going for us. Let's get back here and see what you guys, what the riffraff is talking about here. So let's see. Yeah. Russ has got to keep me on my toes. That's right, man. You'd think I would look his name up, but I didn't. I just pulled it from some slides that I had done. Yes, sir. I am guilty of being human. I am guilty of that every day. Let's see. Let's see. Michael says there was a panic in the 1890s that prior to the Great Depression was called the Great. Oh, okay. I wasn't aware of that. So there was a Great Depression that became the Little Great Depression, I guess, in the 1890s. So 1897. Yeah, I haven't heard of that, but maybe that's a good thing. So El Dynamico says, looks like the herd mentality is rampant right now. I think that's right. I think there's this fear out there. I was actually, for entertainment purposes, I was watching CNBC today, and the hosts on those shows were just losing their minds. I was just laughing at it. And there was a guy on one of the programs that had a balanced view, about what and he was a portfolio manager. He manages people's money. And he was saying, we don't really know what this is going to do, right? We've got to wait and see. We got to wait and see what the numbers are. And he's like, oh, I can't believe you're saying that. It was just nuts. So, you got this extreme fear. And when you have talking heads who, just like weathermen do, when the hurricanes come in and they stand out, in a breezeway when there's a lot of wind, just to kind of get things hyped up. I think, our media is hyping all of this up a bit too much. So I think the fear and the hype are driving that herd mentality. So Antonio, I think you are right on there. Okay, Panic of 1907. This is where we always get our historical facts here. So JP Morgan saved the economic world. Wow. And he's still got a bank named after him. So there you go. El Dynamica is singing, She Thinks My Tractor is Sexy. So there you go. All right, so we are caught up in the chat, and we've gone through my materials here. Oh, I do want to share one other thing with you before I move on. Not that. I want to share with you guys this. All right, so this is my my spreadsheet thing, and it's quite complicated. So it only works for me. It's not anything I could really share, but I enjoy it. So it's got my little dashboard here. You can see that we were down 0.39% for the day. And, it shows me the futures. So it looks like the futures are way up tomorrow. That is fantastic. Look at that, 1.28%. We'll see. It might turn around on a dime. You would just have to wait and see. But I wanted to show you this. Here's my stock listing. So as you know, I track about 100 stocks, and I have certain criteria that I look for. I update them every weekend, and I make a change. If I want to make a change, I'll make it at that point to what I consider my buy list. And I did make a slight change. I made an addition to the buy list. I thought I would share that with you guys tonight. So I'll get rid of the holds. So here we have the buys. And I will tell you, well, let me just tell you what these are, and then I'll tell you how I'm positioning myself on this. So ConocoPhillips has been a buy for quite some time. It went down significantly along with all the other gas and oil or oil and gas stocks. But I still have them as a buy. I think they, and over the long term, are going to be a solid investment. But I'm not loading the boat up on that. As you'll see, I've only got 2.4% of the portfolio in ConocoPhillips. Alphabet, Google is still a buy for the portfolio. I'm sitting here currently with about 5.2% of the portfolio in Google. I think that's going to be a good long-term investment. We see that Amphenol is also on the buy list. I'm now about 3.85% in Amphenol, and they actually went up 3.06% today. So that's fantastic. Now, I did add shares of T. Rowe Price this week. Let me talk about that. I added $10,000 into the portfolio from cash that I have in other places. This was not portfolio cash. It was money that I had set aside. Just really, it was just kind of hanging out. And so I moved $10,000 into the portfolio, and that's in my after-tax account. So in that account, I'm looking for higher yielding stocks. And so I made two purchases while the market has been down here so far, and that is I bought some shares of T. Rowe Price, which has, as of right now, a 6.2% dividend yield. And I also bought some additional shares of Hess Midstream, which is sitting at a 7.8% dividend yield. And let me get the sexy comment off the screen here. Here we go. That's better. All right. So let me make this bigger. You guys can't see that very well. There we go. Does that help? I think that helps a lot, actually. So you can see the stocks that I have on the buy list here. Yeah, and you can also see, so I've added some T. Rowe Price. I've added some Hess Midstream, about 190 shares of Hess Midstream. I'm sitting at about 3.8% of Hess and about 1% of T. Rowe Price. Then I added a stock to the list, and that is Caterpillar. I put Caterpillar on the list. It for several reasons. One is that it is. Let me sort this again here. Largest to smallest. There we go. It is, sitting right about here. It's about midway through the buy list. I think it's going to have a decent return over the next year. Analysts believe it's going to have a decent return over the next year. They're saying 45%. I'm saying 22%. Who knows, right, with tariffs? But I think Caterpillar it's got a wide moat. It is about 34% under its intrinsic value. It has a return on invested capital of 19%, a medium uncertainty range, and a 93 dividend safety score. I think the numbers all make sense for Caterpillar. And at these prices, I think it's going to be worthwhile. I think it's still going down. I have not bought any of it, but I do want to put it on the list as a buy. So I will be keeping an eye on that. Doesn't mean I'll buy any this week, but it does mean that I'm keeping my eye on it. So the other 8 were on the list last week. So I just wanted to point out too that I got about $82,000 to invest. I'm sitting on that at this point, looking for that little bit of positive news that could tell us that we've kind of hit the bottom of this. And I'm seeing futures of 1.28% for the S&P tomorrow. So, I don't know. I don't know what's driving that. We'll just have to wait and see tomorrow. But at some point, I'm going to put most of this back to work in the market. So just to kind of share with you, I've not added Caterpillar to this list, but I wanted to share with you the report card for the stock picks that I've made since I put this model together back in November. And as you can see here, we've got, I also changed this. I was doing it from a weekly perspective. Now I'm doing it from a daily perspective. So you can see these little trend lines on where the stocks have gone. You can see, some have dropped dramatically. But what I do is I compare them to the S&P 500. So if these stocks, since the day I recommended them, have performed better by 2.5% than the S&P 500, they're green. If they are between 2.5% worse than the S&P to 2.5% better than the S&P, then they're yellow. And if they are worse by 2.5% or more, then they are red. And you can see that only one stock is red, and that is ConocoPhillips. And most of that occurred last week with the oil and gas stocks moving. So, we've got quite a bit. Let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 of the stocks that I've recommended in the last 6 months are outperforming the S&P 500 by at least 2.5%. 1, 2, 3, 4, 5 of them are within, kind of like, just a never mind range, which is yellow, and then the one is worse than it, which is down 9.8% versus the market. That's not too bad. I'm really pleased with that performance. I will be measuring this every day, and I'll kind of share this with you when it's meaningful every week. But I'm real pleased with these recommendations. You can see that. I put Hess Midstream back on the list, so let me highlight that one. Now, I have not added Caterpillar to this list, but I will do that because, it's only one day, right? So it doesn't really matter, but I will put that on the list sometime this week. So Caterpillar will start showing up when we talk about it next week. So there you go. There's that little tidbit as well. So then my buddy Russ wanted to look at, or he didn't want me to look at it. He didn't really care if I look at it or not, but I was curious about Starbucks when my buddy Russ says he is investing in Starbucks. So let's go over here and take a look at SBUX. Bum, bum, bum. All right, so dividend safety is around a 60. And again, I haven't looked at Starbucks in quite some time, so we'll see. We'll see what it looks like. But dividend yield is 3.05%. That's pretty reasonable. Let's see, triple B plus for the credit score, so that's not too bad. Let's go down and take a look at some of the numbers. All right, here we go. Dividend growth, the latest is 7%. So that was back in October, 9.3% on a 5-year basis. So that's pretty decent. So 9.3, so that'd be 7 plus 3. So that's about 10. That's not too bad. And their dividend growth is really the way we want to see it, right? It's just up and to the right. But the real telltale is this, the earnings payout ratio. So the thing that fears me, the thing that I'm afeared of with Starbucks is that the payout ratio is climbing. So they are growing their dividend very evenly, very nicely. It looks really good from a dividend growth perspective, but they are giving away the business to match that dividend. So you can see it went from 61% in 23 to 70%, 76%, and now it's 80% in the next 12 months. That's a little concerning. It's an alarming. What do they call it in the dating world today? That's a red flag, for me. So, you can see earnings are decreasing, and sales are flat. Return on invested capital is pretty decent. I'll give them that. It's in the 20% range. I would do that. Net debt to capital, they don't have any debt. They don't have any net debt. They do have debt, and that debt is currently at an 8.7 interest coverage ratio, which is barely kind of where I like to see them. So, yeah, I don't know. Let's take a look at Morningstar, and I want to look up Starbucks on here. And let's see. Yeah, so they're undervalued by about 10%. So now's not a bad time to buy them. So I think it really depends on what do you believe the business is going to do. I know they hired the Chipotle CEO. I think he's supposed to like be the guru in that space. So who knows? Now might be the time to buy it. I just don't know that. I just don't have a conviction for Starbucks, and I love their coffee. I love their food products, their coffee. I go there when I can. I don't have one like right by here. It's probably about 20 minutes away, but sometimes we just go there just because we want to. So anyway, thoughts on Starbucks? I don't know. That's kind of my thoughts on it. All right. What else do you guys want to talk about? Is there anything on your mind tonight? If not, we will cut this thing short. But, tariffs are going to be what tariffs are. So I would just say ride the wave, keep some dry powder, and don't lose your minds. So. Yeah, I think that's it. Well, I tell you what, one other thing that I haven't done yet, which I think is something that would be good to do, and that is to look up Caterpillar. I put them on the buy list. So, 93, 2% dividend yield, an A credit rating. So 93. They've consistently grown their dividend by 7%. For the last 5 years. 8.5% was the latest one back in June of 24. It looks like in June, maybe of this year, they get another chance to impress us with another dividend increase. So that's going to be not this time, but the next dividend. And let's see here. Look at some of the numbers. So their earnings payout ratio is down in the low or mid to high 20% range. I can deal with that. That is awesome. That's an awesome payout ratio. Their cash flow payout ratio is also in the low end. Earnings look like they are dropping a bit over the next 12 months, which kind of makes sense. If everybody believes that the economy is going to slow down with these tariffs, then it does make sense that their business would slow down. Shares outstanding. They've been buying back some shares. Not so much here recently, but they have bought back some. They've got about 489 million shares outstanding. Sales are kind of flat. Return on invested capital is around 18%. So we love to see that. Let's look at net debt to capital is 32%. So that means that they've got 68% of their capital structure is in equity, and only 32% is in debt. And for a company like Caterpillar, that's fantastic. You can even see that borne out in the interest coverage ratio, which shows a 26.49, well above. They say 10 here. I like 8. So it's going to be well above that. So I really like Caterpillar here. I think from a valuation perspective and from a future growth perspective, it's going to treat us right. If you're looking for high dividend yield, it's not the stock for you. But if you're looking for companies that are going to have a nice total return, I think it's worthwhile looking at Caterpillar. Just taking a look and see, first of all, does it fit in your portfolio? But secondly, is it time to take the plunge on an industrial like that? So I'm going to be watching it, but I'm not buying it tomorrow. But I did put it on the buy list. So those are the 8 stocks that I feel convicted about buying. So there you go. El Dynamico says it's all quiet on the Western Front. It is. And, well, yeah, I mean, it's just my opinion. That's that. And what is it? $3.45 gets you a grande Pike Place at Starbucks. So that's my opinion is worth absolutely nothing. So SPY is up 1.66 since the market closed. Yeah, that's interesting. Let me refresh my little spreadsheet here. See what the futures are doing. So we will, it takes it a minute. This is Excel, so it goes out into the market. Yeah, 1.57 right now in the futures market. So that's not the after hours market. That's the futures. So, things are heating up. So, and that just goes back to a point that I like to make, is that a lot of times you can't catch the bottom. The bottom happens after hours. So it's not much, not even after hours. It happens off hours. And so there's just not a lot you can do about it. The market closes low one day and opens up really high the next. So, so it's good to be, somewhat invested. I do have some dry powder, so we'll see. We'll see what happens. That's good stuff. All right, guys. Anything else you want to look at before we get off of here? And if not, my granddaughter's in the other room. She's actually come and knocked on the door here a couple of times, and so I think she wants me to come play. So I'm good with that. All right, guys. Well, that's going to be it for tonight. I'm going to go play with my granddaughter, and we'll play with her toys or something like that. Oh yeah. So Rust is about CSL Carlisle. Yeah, I mean, we still got a little bit of time, so I will take that, Nathan. And let's take a look real quick at CSL. Dun, 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 dun. Here we go. All right, CSL. Let's take a look at it in Simply Safe Dividends. It is a 99 dividend safety score, 1.22 dividend yield. It's not for those who love high dividend yield, but it does grow its dividend. It's got a triple B credit rating, so it's 1 notch above, or 2 notches above investment grade. And let's take a look at, so 15.5% over 5 years and 17.6% this past year. It's had a 48-year dividend growth streak. And the telltale is earnings per payout ratio. When a company, so I'll share this. I know I shared it a lot, but I don't think people really understand this. This will be worth the price of admission right here. When you see a company growing its dividend significantly over let's say a 5-year period, 15.5% per year, and then you come down and you take a look at their payout ratio, what this tells you is the payout ratio is relatively flat. And when the payout ratio is flat and they're growing their dividend, that means the business is growing, or they're buying back shares in such a way that they're paying for those dividend increases. So they are managing the company. They're keeping capital in the company to grow the company, but they're also paying out dividends, and they're not growing those dividends without providing value to the shareholder, if that makes any sense. So 18%, pretty flat. That means as the dividends go up, the earnings go up. Dividends go up, earnings go up, and so that keeps that earnings payout ratio flat. So I love to see that. I love that in Carlisle. They've been buying back shares. Return on invested capital is around 19%. That's pretty consistent with some other stuff we're looking at. Net debt to capital is not terrible, 34%, and interest coverage is really good at 15.27. So yeah, Carlisle is a solid stock. Let me take a look at it here from my little list here. I'm going to just hide everything but Carlisle. Carlisle. All right, I've only got 1.15% of that, or it's only 1.15% of the portfolio. And looks like I've got it like at a 21% annual return. Analysts are at 43%. But, you know, analysts are really slow to back down their numbers. So don't, I mean, I use that really more as just something that'll compare. That'll compare to what I've got. So then Morningstar has them with a narrow moat. They're 14% undervalued. Return on invested capital here is 17%, and that comes from Morningstar. They have low fair value uncertainty and a dividend safety rating of 99. Dividend yield of 1.2%. They have been buying back shares like crazy, 10.5%. Remember, this is probably why we're seeing the payout ratio low, because they're buying back shares that then they can use the dividends that they were paying to on those bought back shares to actually grow dividends for the rest of us. So, yeah. So I think that's good. So Love It here says their return is bigly negative. 1 year is a negative 18%. Yeah, that's why it is such a good value now. Let's see here. Let's take a look at let's pull up CSL on tip ranks. And what you guys see here is that over the 1 day, it's off just a hair, 2%, 3 months is 12, 6 is 20, almost 29. Year to date's 11. 1 year is 17.54%. So yeah, it's down quite a bit. And you know, I think if we were to look at, let's take a look at the at VU and see what it's doing. Yeah, VU's only down 1%. So one of the things we want to find are companies who have been trading at above their fair value, because those are typically the companies that investors think have high quality. And then all of a sudden they are trading now lower. And then we have to understand why that is. So, but at the end of the day, it is that drop of 18% that actually makes their price attractive to, you know, us value investors. So, yeah, no, you're right. It has dropped 18% over the last year. But I believe, and based on information that I have, let's take a look real quick. CSL, Carlisle. They're they don't even have it. But anyway, the fair value looks to be around 404 according to Morningstar, so it's trading at a 19% discount. You know, so if you believe that, then it's worth more than it's trading for today, and so So if they're down 18%, that means they were trading at fair value about a year ago. Because if they were at fair value, now they're at a 19% discount. They're down 18%. So that's what kind of makes it attractive to me. And from the long term, I think it's got some. They got a quality balance sheet. They got a great management team, and so there's just a lot that I like about them. So, but yeah, just because it's gone down doesn't mean it's going to keep going down. It might actually turn around and go back up. That's what we hope. Yeah, they have it as a 5-star, which is a highly discounted stock in Morningstar. So, all right, guys. So we are at an hour. Yeah, not that bad during the Tariff Armageddon. I like the way you put that. That's good thought. All right, guys. Well, with that, we have hit an hour, and I'm going to get off here and go play with my granddaughter with her toys. And so with that, we'll see you guys on the next one. Hope you guys have a great week. And, just stay, don't let your emotions get the best of you. That's all I can say. So good luck, and I'll see you guys next Monday.